Welcome to a special Women in Wealth episode of the Exceptional Advisor podcast series. In this episode, we celebrate Women in Wealth Week, March 8th through the 14th, 2021, in conjunction with International Women's Day, celebrated worldwide on March 8th. Join us on social every day as we feature the perspectives of women in wealth. Launched in 2019, the Institute's Women in Wealth program promotes and celebrates gender diversity in the financial advice profession. The program raises funds to support the Women in Wealth Certification Scholarship Fund, build community, and ultimately improve the professionalism, ethics, and expertise of women advisors and accelerate career advancement and success. To learn more, visit www.investmentsandwealth.org/women-in-wealth. Hi, I'm your host, Bob Powell, and today my guests are Margaret Towle and Sidney Wigfall. Margaret is managing member of Yakima River Partners and an advisor to Avrio Technology, a fintech platform that offers investment models solutions across all asset classes. Margaret is also the former editor-in-chief of the Institute's Journal of Investment Consulting and former chair of the Investments and Wealth Monitor's Editorial Advisory Board. Sidney is the Chicago-based founding and managing partner, consultant, and managing corporate counsel of SCA Compliance and Consulting Group and SCA Corporate and Compliance Counsel Group. So welcome to the podcast, Margaret and Sidney.
Thank you.
Thank you.
Pleasure to have you here. So before we get going, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us each a brief overview?
Sure, I'll go first. I have been in the financial services business for over 30 years in a variety of different positions, primarily in asset management and working with institutional clients and the uber wealthy. Within the context of ESG, this is something that I've been investing in for the last several years, primarily as a senior portfolio manager at a large financial institution. And currently I'm with Avrio Technology, which is a fintech platform that focuses exclusively on sustainable investing.
And Margaret, you should mention your involvement with the Monitor and the Investments and Wealth Institute. We would be remiss.
All right. Well, those are two of my favorite publications, or three now, with the retirement publication. For a number of years, I was editor-in-chief of the Monitor, which is a great publication for practitioners in the business. And then for a number of years, I also was editor of the Journal of Investment Consulting, which is an academic journal that's a blind peer review, and just stepped down last year, although I'm still on the editorial board. And I should just do one little plug for these publications. I found as a professional with a strong academic background that these publications really help financial advisors and investors in general keep up with what's going on, both from a practice management, but also theoretical perspective. So I think they're great publications. And then more recently, the retirement publication, I think, is needed now because there's so many changes going on in the retirement space, which we're going to talk about today.
We are. Sidney?
Yes. Sidney Wigfall. I'm a founder and managing partner and consultant counsel of SCA Compliance and Corporate Counsel Group. And we're a boutique hybrid multidisciplinary practice that focuses on advising firms on a range of issues related to asset management firms, investment firms, RIAs, and fund managers as well, and funds. And by training, I'm a securities lawyer and also worked at the Securities and Exchange Commission in New York for several years, and then moved into the large law firm practice areas, where I worked with a couple of large law firms, including Morgan Lewis, which is a large and then also moved after that to in-house positions where I worked as general counsel, chief legal officer, and chief compliance officer for a range of institutional asset managers and fund groups, covered the whole gamut, 40 Act funds, private funds, large institutional clients, separate accounts, and also delved into mergers and acquisitions as well in supporting RIA firms and broker-dealers. In terms of being introduced to the ESG area, it was through working with clients in helping them to set up new RIAs where they had overlay products that involved at the time SRI, or socially responsible investments, mainly based on negative screening, and then continued to work with those asset managers as consulting and counsel clients in terms of developing new products, how they market those products. And then we also got involved with some of the industry associations as well, including SRI in the Rockies, also the Social Investment Forum. And so that was sort of the beginnings in getting involved in it. And also I've written an article for the Monitor several years back when I first moved into the practice of consultancy and having my own boutique group, which was back in around 2005, and worked on that article. And it was focused around best practices for regulatory and compliance consultants and being able to add strategic value to firms in terms of how they manage their compliance program and compliance risk.
Well, it's a pleasure to have you both here on the Exceptional Advisor podcast. So let's dive in. Margaret, let's start with you and do a little bit of table setting. With respect to ESG, can you give us a definition of it, a little bit of a history, talk a little bit about the myths and some of the realities associated with ESG investing?
Absolutely. And we just talked about the Monitor. There's an article that was published in the Monitor last year that really touches this. It's environmental, social, and governance investing, myths versus reality. So I'm going to be taking some of the concepts out of that, but it certainly is a great resource, I think, for financial advisors. Let's talk about definition, because there are so many different ways of looking at this type of investing. And many years ago, people probably remember what was called SRI, socially responsible investing, and that was primarily a negative screen. And as we get further on in the podcast, we're going to talk a little bit about what criteria do you use to make sure that you're looking at financial measures. And this was a bit of a challenge because it was screening out companies based purely on someone's values. You know, do you believe in divestiture from fossil fuels? Then let's screen those out. Do you believe that we shouldn't have any weapons? Let's screen that out. Tobacco. There were some faith-based ones based on religious criteria. And so this really is not what we're talking about with ESG investing. And there's another aspect too that I think it's important to set these aside and really consider them separately. The other is what I would call impact investing. And that is for investors, which may apply some of the same criteria, but they are really interested in what's the impact. You know, do we want to eliminate poverty, or we want better housing, or whatever it happens to be. And that's the primary consideration. And ESG investing is not that as well. But what ESG investing is, and again, this is my definition, but it's consistent with the way the industry is going. It's really the issues and factors that investors consider regarding a firm's sustainable business practices. And what does that mean? Well, it means that firms want to be around tomorrow. And so sustainable could mean how you treat your employees, or how do you conserve water, and a number of other things. And so what we look at when we look at impact investing is, what are the metrics that we can use to measure these sustainable practices? And if you talked to me 40 years ago, I'd say, well, you know, it's easy, because we're going to look at what is the debt level? What are the earnings? What's the inventory? All of these things that are really called tangible assets. And that kind of made sense because companies primarily made widgets. And so we could look at those tangible things. And 40 years ago, the S&P 500, if we look at what the value of the S&P 500 is, consisted of tangible assets. And so it made sense to use those metrics. And today, 40 years later, over 80% of the S&P 500 consists of intangible assets. So we're talking about the cloud versus widgets. And we're talking about companies that dominate the S&P 500 that are companies like Apple and Amazon and Facebook and Google. And so today, the S&P 500 consists primarily of intangible assets. So we're not going to throw out the traditional metrics, which are fundamental, but what we're going to do is figure out what are material metrics to measure these kinds of things like the cloud or your supply chain management or how you treat your employees. And so for me, ESG investing is looking at what's material on an industry by industry basis and then measuring that. And research most recently, Morgan Stanley, Merrill Lynch, a number of other research arms have really quantified that it makes sense to look at these non-financial factors for intangible assets. You have lower cost of capital, that's a good thing. You have greater productivity. You have generally better risk control and a number of other things. So that aspect of ESG investing is what I think investors want to focus on if they do want to outperform. And so again, for me, I characterize it in terms of risks and opportunities. And that's very consistent with looking at financial factors. Those are the things we're looking at as well. And so we look at these and then we determine best in class. And I just want to make a couple of caveats because I think, again, there's misunderstanding in this space. One of them is that there is no paragon of ESG investing. So if we look at a company, they're not going to be perfect across the board. I'll give a couple of examples, and these are just relative to the scoring metrics that we used. And so I'm not making stock recommendations, and I'm using these as examples. But a few years ago, Walmart created a wonderful distribution center. It was very sustainable, it was very efficient, and it really conserved a lot of resources. So that's great. Walmart is a big company with a lot of distribution, and so that made sense. So that score relative to their distribution and sustainability was actually very good. But then if we look at the S factor, the social factor, how does Walmart relate to its employees? Well, you know what? Maybe not so well. And so Walmart has a lot of employees that are not working full time. It may be people that are, managing two jobs or kids and all of that. And so Walmart didn't do a great job in helping these employees schedule their work hours. They might call them the day before and say, hey, can you come in tomorrow at 2? So they did not score well on the S factor. Now, what difference does this make? Well, they did well in distribution, but what about the S? Well, it turns out that for retailers, the S factor is really important because your employees are the most important contribution to your productivity. And if we look at the E factor for retailers, you can only do so much in terms of saving water or whatever it is that you're doing, recycling your paper. And so for us investing, it's not enough to identify the metrics, it's to identify what is material. And getting back to our whole discussion today, we find that if you look at industries and what is material to that industry, then you're going to really have an insight into how that company is going to perform. And I'll just mention one other thing, and that is that there's a catalyst that I don't know if the DOL or the SEC is looking at this, but corporations are recognizing, hey, Starbucks is a good example. If I treat my employees well, I'm going to have lower turnover. I'm going to be more productive. So what does Starbucks do? They're offering college education to their employees. That would be something that's not really part of their mainstream business, but it is part of the S factor. How do you treat your employees? So I think we're seeing Larry Fink at BlackRock come out and say, you know what? We think purpose and profit, not one before the other, but both of them, or the Business Roundtable or a number of others. So for me, I think that looking at this from a perspective of regulation, it's important to include these non-financial or intangible considerations, but follow a process. And maybe later on we'll touch on what that process might be, but that's the key. Follow your process, just as you would before ESG. Any good investor must follow a process.
Yeah. So a couple follow-up questions. In your article, you mentioned you have a list of terms, ESG, impact, responsible, socially responsible, which you talked about, and sustainable, and you gave definitions for all of these, which I would certainly encourage people to read your article, if only to get a sense of the differences between these terms. But do you want to further define those terms and how they're different? And then secondly, would you want to touch on some of the myths that you identified in the article?
Sure. As far as the terms, there are a lot of terms. And I think that, it really is kind of difficult because the environmental and social and governance, at least from the way that we're looking at it, is really identifying issues and factors that are in those three different buckets: environmental, social, and governance. And I talked about this a little bit a few minutes ago, but those factors there's hundreds of these factors, but they have to be material to that particular industry. And so I should just mention, there's something called SASB, Sustainability Accounting Standards Board. And I know in the recent DOL discussion, there was some question about whether standards exist, and they don't really exist. But one of the ideas of standards is just the definitional thing. What are we dealing with? But SASB has done it's SASB.org, has done a pretty good job in outlining material issues by industry. Now, one thing that's different about SASB is that they've created unique industry classifications. So I'll give you an example. The oil industry, you could be exploring oil, you can be distributing oil, you can do all number of things, and the factors that are important are different. So exploration, we've seen what happens when oil companies don't consider the risks of drilling offshore, things like that. But if you're driving a truck to deliver, fuel to someone's house, those are completely different risks or metrics. So the ESG is really those metrics and issues. As far as the impact investing, we talked a little bit about it. That's impact first. And I know a number of, especially nonprofits, have attempted to quantify impact. It's an impossible task. I mean, I like to say that, impact is really in the eye of the beholder. And there's some discussion, for example, if we look at philanthropists that invest in ESG, they're talking about audacious investing. They want to have a big impact. Well, how do you measure that? So I think that is a rabbit hole that is very difficult. And if there was a misunderstanding on the part of DOL or SEC that investors are looking at impact, that doesn't work. So, but it is important for investors who especially want impact first. They want to do those things. And
Yeah.
then,
Well, if I could interrupt you for a second, I've talked to some managers who, and I'm not sure if this qualifies, but when you think about persuading companies to change through shareholder proxy voting, any thoughts, and the degree to which people change their business practices because of institutional shareholders using the muscle of their shares owned to change things for the better.
right. Well, and I'm sure Sidney is more knowledgeable in this space than I am, but what we've seen is an attempt basically to kind of edge out shareholders by making requirements for voicing concerns a lot more difficult. So if you're a small shareholder in the past, you could always say, hey, I'm going to show up at the meeting and, we're going to talk about this. So I think that we have to look at two things when we're looking at this. One, we have to look at the way the world is right now. And the way the world is right now, we're under ERISA and we have DOL regulating retirement plans. And we have the SEC that's regulating advisors. And so, as far as those proxy or things that are consistent with the law, I'm not sure that's going to change. But what is changing is exogenous things like companies recognizing that it's stakeholders, not just shareholders, that they need to respond to. So personally, I don't think the change is going to come about from these regulatory agencies opening up the definition, even of responsible investing. But what we've seen even in the last year or so is that not just in the investment arena, but just in the world in general, people are wondering, what are our responsibilities, for the environment, for social justice, for a number of issues. And so I see a groundswell that's not just in the investment industry, but in others. But as far as the actual legislation and things, I think there's going to be a time for that to change.
Yeah. So we can return to the myths in a second. I want to give Sidney a chance to talk a bit about, since you brought it up, the regulations of retirement plans and investing and what's going on with respect to ERISA and DOL, which is in the news at the moment. Sidney?
Sure. Well, what you've seen from the regulatory side is primarily driven, again, by the DOL with respect to retirement plans. And typically, you're going to be talking about corporate retirement plans. Some years ago, just from a historical perspective, the ERISA regulations, which at one time used to cover both corporate as well as public retirement and pension plans, the terms were, or the terms of the statute and the regulation were updated to remove the public plans from that oversight. So typically, public plans are going to be subject to the pension laws of their particular state. So with that in mind, you then are left with the model of the basic rules of ERISA applying to corporate retirement and pension plans, defined benefit, as well as defined contribution for 401k plans and those types of structures. And the approach that the DOL has taken historically is to focus on the ERISA fiduciary duties and looking at whether or not the investments which would have ESG components or be ESG based would satisfy the duties of prudence and loyalty in terms of being solely focused on maximizing the benefits for the retirement plan participants. So with ESG being deemed non-pecuniary factors, then that puts some tension into play. And the DOL has historically addressed that through indicating that if you basically follow the standard of you have to focus as your primary factor on financial or economic benefits, and you can consider other factors, but but economic benefits or financial benefits have to be primary. And if you have investment alternatives where all things being equal, they're on equal footing in terms of the economic benefits, then you can, in that instance, consider ESG or non-pecuniary factors as part of that mix in terms of choosing an ESG investment. So as long as you're satisfying all things being equal in terms of how the investments are side by side, you're allowed within your fiduciary exercise of discretion to be able to use ESG investments.
So my understanding is that's under current,
right.
There's a proposed rule that would change that, or?
Correct, that's correct. So the proposed rule seems to be moving more towards restricting that discretion and making it tougher for ERISA fiduciaries to choose ESG investments, partly because they're now indicating that you can't subordinate financial concerns to any instances of non-pecuniary or ESG factors. And they're also adding a documentation requirement as well. So you have to, as a fiduciary, you have to be able to demonstrate and then document that the investment is fulfilling both the financial and economic benefits, as well as how you're quantifying or measuring the ESG benefits. And you have to be able to monitor for those factors as well and be able to document the reasons why you're choosing the ESG alternative. So it's making the process much more limiting or restrictive. And then on top of that, the DOL had taken steps to send out letters to various retirement plan participants, not participants, but retirement plan sponsors, where they requested information through their enforcement division in terms of at least seemingly wanting to get a better understanding of how is ESG or ESG products being viewed, being reviewed by plan sponsors and their consultants, and being included as part of options within a defined benefit plan or included in any kind of defined contribution plan.
Mm. It seems interesting, this proposed rule, in light of the DOL allowing retirement plans to invest in hedge funds and private PE, private equity.
Right. So they certainly, and part of this comes into, and Margaret may have some thoughts on this as well, sort of the political factors that come into play. Typically, you've seen with Republican administrations who have been a bit more restrictive in how they have interpreted the DOL's, I guess, scope of authority, application of its rules and standards. And you've seen typically with Democratic administrations that they've been more flexible in terms of being open to considering alternative products that didn't necessarily fit into the traditional mold of investment sort of standard stocks and bonds that are publicly traded. So that has certainly had an influencing factor on how the DOL has approached these different areas and in terms of related rulemaking. Excuse me. In terms of also, you have the SEC as well on the asset manager or RIA side, and they are also reviewing and looking at possible rulemaking with respect to ESG funds. Now, they're coming at it primarily from a mutual or 40 Act fund perspective and considering whether or not to have ESG funds be covered by the fund name rule, which basically says that any mutual fund or 40 Act fund, if they include a certain descriptive factor that's part of their name and it's deemed to be covered by the fund name rule, then at least 80% of their holdings have to fall within that descriptive name. So that would certainly have an influence in terms of, well, how are you rating or defining your different ESG factors, and in terms of how the fund is constructed or the product strategy is constructed in terms of what holdings you can have, and then how are you researching and monitoring those holdings to make sure that you're maintaining your 80% holdings threshold. And then they're also looking at it in terms of from the marketing and sort of truth and labeling side, and whether or not what you're describing or how you're defining ESG, since it tends to be a somewhat broad term, how are you defining that for purposes of your clients as well as prospects? And is the fund as constructed being managed, or is the separate account, if it's a separate account vehicle, is that being managed in accordance with the reasonable expectations of the investors based on the disclosures that you've made to those investors?
So in light of all the, what's the term of art, greenwashing that's gone on, does it strike you that this is an appropriate action on the part of the SEC?
It is an appropriate action. I think the SEC is probably a bit more, and again, this kind of connects into the political structure as well. With the SEC, they are a 5-member commission, and the SEC chair is designated consistent with the party of the president at the time. So you will have a majority of the 5-person commission. So what you see is, I would say, certainly some skepticism regarding ESG, how it's being defined. What are the ratings? Are they internally developed proprietary ratings by an RIA or asset manager? Or is there reliance on third-party ratings? And how rigorous is that process? And that's the approach that the SEC is tending to look at it in that perspective. Now, it could certainly link up as well with the fiduciary duties as well, which is sort of the DOL framework by which they're coming at it. Because you don't want to, the concern is that using terminology that is not easily definable, is there a risk, and especially with respect to retail investors, is there a risk that it's going to mislead them as to what the product is expected to do? And then on the back end, if you start to have style drift or not keeping investments in the product that are consistent with the parameters as to how it was advertised, then you are potentially exposing the RIA firm to fiduciary risk, because you're now engaging in a practice that's not consistent with what you've disclosed is the investment parameters of this particular product.
So, Margaret, I want to ask you about the implications for ESG investors, but first, Sidney, could you just give us a sense of where we are with respect to that rule?
So the process is typically done for a 30-day comment period, in which kind of came to an end with the end of summer. And now I think the DOL will probably take the tack of continuing to incorporate and look at the comments that came in, which in large measure were critical of the proposed rule. But I suspect that they're probably going to still move forward at some level in terms of adding language that deals with this guidance or guidance that they've provided over the years, but codify it or make it part of the regulation. Now, there is the risk that if they are not able to make it or move it to a final rule adoption, and they may have this risk even if they are able to, if there's a change in administrations with the upcoming election, then there can be some either move to undo or modify some of the guidance related to the rule or the regulations, or modifying some of that language. So I would say they're probably going to be focused on trying to come up with a final rule that they can get adopted probably sometime in November, maybe early December, would be my guess.
All right. So, Margaret, lots of implications for ESG investors if all this comes to bear.
There are. I think a couple of things, though, just hearing Sidney speak and thinking about what has happened in the past. One, just a little factoid. The world is changing so rapidly, and the regulations that we have perhaps don't fit. But even the word pecuniary, a long time ago, it's from the Latin word for cattle. And that really was what people used, in terms of measuring their profits or financial return. So, even the terminology is dated that we're looking at. But sometimes change comes from without. Sidney mentioned the public fund and the private fund, and we talked about hedge funds and private equity. This was in the 90s, but when hedge funds just came into being and people were looking at them, and the same with private equity, the state funds were the ones that went ahead and used these things. And I remember the state of Oregon, and there was a guy who was chairman of that committee named Roger Meyer, a really smart guy, and did a lot of innovative things for Oregon. But I think they were the first pension fund, it was a public fund, to go into KKR. And so that served as a catalyst. Then eventually the corporate side caught up with that. And Sidney knows better than I do in terms of how these regs apply. But I have seen state funds, even this comment now recently of state funds that are commenting on ESG. And their comments are, we're not going to get rid of ESG, but what we're going to do is make sure that we clearly articulate what the expectations are. And again, as one who's been on retirement investment committees, as well as advising retirement plans, as a fiduciary, you're really not getting into the weeds, like, how are you investing? What you're doing is looking at the process that you've delegated to your agents. And so I'm just wondering, and this, I don't know if we can answer it during this call, but if we look at the whole spectrum of investing, there is no one way of investing. There's value and growth, and they're looking at different factors in that. Or there's people who use technical analysis, but do they use it exclusively? No, they look at other things. And so from an investment perspective, the idea of ESG is not the only driving force or the only factor. But I was speaking with a very savvy asset manager who said, we don't really do ESG. And I said, well, guess what? You're looking at how management treats the employee, is there diversity within the organization, all kinds of metrics that people would consider ESG metrics. And so I think we're in this period. A similar situation occurs with digital assets. And in terms of regulatory agencies in the United States, not Europe or other places, because they figured out how to regulate those. But what do we do with this? Because I think what our audience, financial advisors and fiduciaries and others need to remember is that nothing is a static situation. Many, many years ago, when I was working with uber wealthy and philanthropists and they wanted to do SRI, I would say to them, if you really want to do well, just make a lot of money and then, give it to charity. Because I didn't feel that as an investment professional, that was going to be consistent with their generating a return. They're better off letting the organization do that. It's kind of like share buyback versus, that. But today I've changed my thinking because the world has changed. And so I think that's one thing we need to keep in mind. The other is, I think, the point you brought up, Bob, about greenwashing. This is actually a really good lesson for the investment industry, because I'm not saying that every ESG fund is really ESG. And if you look at the proliferation of ETFs around ESG and mutual funds and all of that, and then you look at the holdings, maybe some of them need to think a little bit more closely about that. But getting back to the other implication, which is really the implication for standards. And I think that we really need to think carefully about this. Do we really want one standard for ESG? Because we don't have one standard for, wow, this is how Warren Buffett does it. Oh, but somebody else might do it a different way. And so I'm not really sure there is one standard. Or even back to the discussion about impact investing, I was on a committee for a very, very savvy foundation. And they wanted this committee to come up with measurements of impacts. And there were sociologists on it and investors and all kinds of people. And we couldn't do it. So I think that we need to look at the landscape of investing and be pragmatic about what this ESG is. And I was talking to Sidney earlier, and I was saying, when somebody figures out how to capture inefficiencies to, mitigate risk and find opportunities, it's usually a holistic approach. And so this idea of integration of ESG is just integrating these other measurements that contribute to a firm being profitable. And it's as simple as that. And a lot of people use different measurements. So I'm not sure if anyone made that case to Department of Labor, but it would be something to think about.
Well, it would be interesting, right? I mean, you sort of hinted at it. We don't have there's nothing that says this is how you do value investing, or this is how you do growth investing, or this is how you do smart beta investing, right? It's not, those things are not subject to the same thing that ESG is about to become subject to. Right.
Or even when the ESG first started, there was a discussion, you can never do passive ESG, it has to be active. But look at all the passive funds now that are using ESG screens along with other. And that's the thing. When I invest a portfolio, I do look at the fundamentals. But for me, it's almost commoditized because you can go to India and have the calculation of all the financial ratios. And so that's a check the box thing for me. But managing a portfolio, as I said, is holistic. It's not just your screen. It's not just your philosophy. It's your portfolio construction. It's your risk management. So all of these things still have to be in place, whether it's ESG investing or growth or value or whatever it is.
Yeah. In your article, Margaret, too, you mentioned one of the myths is that ESG funds would underperform broad general market funds, and that's not been the case. Certainly not this year. They've outperformed their non-ESG peer groups.
Yeah, and again, consistent with this idea of performance, growth and value don't perform the same in the same market environments. And the attributes that they found about ESG using those metrics for portfolio analysis is that it generally requires a longer term perspective. So it's a little more type of value. You don't know if you're going to treat your employees well. It's not going to happen in a quarter. And so that's one thing. But the other thing about it is that the ESG investing is is complementary to other ways of investing. And so, like I said, in my portfolio, when I was managing the portfolio, I used a very well established scoring methodology and determined some of what the materiality was using those standards that SASB had. But then for my risk management, I used a vendor that uses the tools of artificial intelligence to provide an outside view of the corporation in terms of controversy risk. And I can just say from practical experience, it sounds kind of weird, but there were instances of names, very big names that I'm sure you'd know that had big controversies. Before the controversy came out, this behavior or actions of corporations being measured in a different way. That didn't drive my whole decision. That was kind of like technical analysis. It's like, okay, I did the fundamental, I did the ESG scoring, I did the portfolio construction, and now one of my tools in risk management is, are there potential for controversy based on what people are saying in the outside world? And this vendor has done a really good job in, just using that outside view. So that's another tool. It's a toolkit. That's what we're talking about.
So it's interesting. I wouldn't pass a test on the article, but I think in a recent issue of the Harvard Business Review, there was an article by a gentleman from Sustainalytics, I believe. And so this topic of ESG is now being put forth in front of the corporate leaders of the country, and I can't imagine that it won't get noticed if it hasn't already, given what Larry Fink and others have done too.
Well, I know that maybe smart leaders didn't identify it as such, but if you look at, and a lot of CEOs like to write books about what they're doing, and whether it's Howard Schultz, with the whatever it is, one cup at a time, and so I think that they are figuring it out. And as I said, the external environment now is causing people to just re-examine their value system and what works and what doesn't. So I'm optimistic regarding that, in spite of recent DOL action.
Yeah, I mean, I look at it and I think I saw a commercial from Amazon on the other day that talked about their desire to be, having a carbon neutral footprint. Or I watch advertisements from Coca-Cola saying they want to be stewards of our world's water.
Mm-hmm.
And so it's interesting that these companies are now putting that face forward because they know their customers, right, their stakeholders are interested in that.
Well, and that's back to that outside view, because historically, it's like, oh, let's just do what we want. Basically, if shareholders are happy and we're generating earnings every quarter, but people are recognizing that other things contribute to profitability besides just these fundamental factors. Amazon is an interesting example because historically, a few years ago, Amazon did not score that well sustainability-wise. And I think they've recognized, partially as a result of this COVID situation, that they have to pay attention to their employees. Are they protecting their safety? Are they protecting their supply chain? And how can they offset some of these climate imbalances? So I think we're going to see a lot of innovation on the part of companies. And if people don't want to call it ESG, just call it good management, and maybe that's a better way to go.
Yeah. So where do we go from here? We're touching on it a little bit, but what's in your crystal ball?
Do you want to go first, Sidney, or?
Yeah. Sure. Well, I think in terms of going forward, there's certainly some interesting developments in terms of sort of the DOL process will continue to play out, and that'll be through the end of this year. The approach that the SEC has taken is to actually put what's called an asset management advisory committee in place, and they have created an ESG subcommittee. So through that vehicle, the ESG subcommittee is in the process of formulating recommendations, which are advisory only, but it helps to give the SEC commissioners and then the SEC staff at least sort of a industry input platform through which to then decide which way that they want to go. And I think that's going to help because at least two of the Republican commissioners who are somewhat skeptical of the process in terms of ESG, I think they're going to take the approach that they don't want to necessarily stifle innovation. And I think this kind of connects back with Margaret's point about how sort of the outside factors or outside industry impetus is going to push this along in terms of both the ratings. They don't want to necessarily stifle that process. They don't necessarily want to sort of pick a winner or loser per se by designating one set of ratings, as being the standard by which things should be measured. So I think they're on a sort of similar timeline in terms of with the end of the year, again, with the change in potential change in administrations. So I think the SEC is going to take those recommendations and be able to come forward with maybe sort of a light touch plan where they may provide some limited guidance. I think they're going to be very hesitant to impose new obligations on the corporate issuers per se in terms of their disclosures. But I think they're going for the asset managers or the RIA side. I think they're going to push that a little bit, and they may go with sort of a light touch regulation to make sure that the ESG is being appropriately disclosed, defined in terms of what the parameters are, what the product is supposed to do, and at enough of a level that the asset managers or RIAs are able to demonstrate that they're managing the product within those parameters and making appropriate disclosures. And again, this ties in with the SEC's approach, which tends to be a disclosure-based framework. So you make appropriate disclosures and you monitor and make sure that your product is operating within your parameters. And then from the institutional side, I think the process is going to continue to be driven by the large institutional investors as well. You have the CFA Institute, which has teamed up with the UN Principal PRI group or association, and they're helping to put forth a set of recommendations as well as case studies around how to have or build ESG integration so that it is more seen as more connected to looking at or taking your ESG factors and having that connected to financial economic factors as well as part of your overall investment process. And the SEC is also taking the tack as well as doing examinations. So since at least 2018, they've been doing some examinations where they have a set of questions, anywhere from 20 to 25, that focus on ESG firms. And they're asking about information regarding how do you define ESG? Are you relying on proprietary research or ratings? Are you relying on third parties? Are you involved with outside industry groups such as the PRI? So again, it's kind of making sure that firms are what they're putting out there as being their framework for ESG investing is going to be true to that. But certainly the SEC will not want to stifle innovation sort of on the rating side. So I don't see them necessarily setting one rating standard that they approve.
Yeah. I mean, that doesn't sound like a high hurdle for companies like, I don't know, Eaton Vance and Calvert and others that have been in this space for many years
Right.
at all, does it?
Right. I would agree.
Yeah. Margaret, what does the future hold from your vantage point?
Well, I think you mentioned myths, and I'd like to bust a few myths because I think that's where we're going. And the first myth, and I've spoken with a lot of, when I was at the previous financial institution, I was doing in-house, management for basically retail financial advisors. And one of the myths that happens when I would speak with these advisors is like, I don't think my clients really care about ESG, And well, the article points out a few statistics, but there's a couple of them that I think really stand out for me. One is that 71% of investors, it's probably higher now, worldwide are interested in incorporating ESG factors in their investment process. And so however they define it, they at least want that, which is one explanation for the tremendous growth of products in the last year or two of ESG investing. But of that, if we look at financial advisors, there was a great poll done where they were polling clients, and these clients, they said, have you talked about ESG with your financial advisor? And only 14% said, yes, we have. But the amazing thing is that 61% of those conversations were initiated by the client. So that says to me that advisors better figure this out, that people do want to look at this investing. And part of it, I think, is a communication issue. It's perhaps the way that advisors are communicating this. I had a client who was extremely wealthy, and he was, investing all over the place. And I just sat down and I said, James, what do you really want to do with your money? And it was like, whoa, nobody's ever asked me that. So I think the communication process is very, very important. And there's, behavioral finance and all those tools will help advisors communicate. So that's the first myth. I do think that clients care about ESG investing. The second myth that I've heard is, this is just a fad, it's going to pass like everything else. But I think we've seen when you have large financial institutions who were by the sidelines, with a few exceptions, all jumping into the space now, they're not the first ones in. I mean, there have been firms that have been around for years doing ESG investing, but all of a sudden, all of the big wirehouses, the big banks, it's going to be here. And whether we call it ESG investing in 20 years, I don't think we will, but it'll still be around in terms of what we're doing on that. The other myth that's the one that's discussed probably most often is the performance myth. And you mentioned, Bob, the data that are coming out now regarding performance. I think that we need to really understand, just as we would with any investment approach, when are they going to do well and when are they not going to do well? I like to look at a drawdown, and the bull-bear spread with a drawdown. So in bull markets, how did it do? In bear markets, and also the batting average, what is your average in up markets and down markets? And then use that manager or that approach to fit whatever bucket you need in your portfolio. And they are different in terms of people who approach that. But I think the biggest one, and I've talked about this before, but being in the Pacific Northwest, it's like, well, no wonder you like ESG, you come from Seattle. But I think that this myth that ESG is just a feel-good factor. And it's not necessarily just a feel-good factor, but as I say in the article, if your clients are going to capture some inefficiencies and get some good performance, doesn't that feel good too? So maybe it is a feel-good factor, but it's also letting clients kind of have a say and a commitment in how you're investing their portfolio. And I find it's really an attention getter. And I've had a number of clients, and I'd sit through meetings with them, and they'd be, looking through their calendar or other things, they just didn't care. But when you talk about this values or changing the world or those kinds of things, they really get plugged into the discussion. So it's not just a feel-good factor, but it does feel good.
Yeah. Let me go back to the first myth about clients not caring about this and advisors not talking about it. Um, Others, and you in the article mentioned that the need for training and education so that advisors feel more competent to talk about this. Is that part of the problem, that advisors shy away because they don't know what to say?
Yeah, I think that is part of it. Part of it too is you have to consider what structure you come from. And I think advisors misunderstand that, oh, well, we've got a buy list, or here's how we have to do it. That there is room for creativity. There's been a lot written in some of the publications, that we talked about, but in others as well, on how the role of the financial advisor is changing. And in a sense, the advisor is pulling together a lot of information. They just don't have the resources to research every name and everything. So moving away from stock selection to looking at, the buzzword in the industry, looking at solutions, but really they're looking at products to see how they fit the client. So I do think advisors need education in just even the terminology. It's funny, my husband, I was talking to him about a year and a half ago about this, and he's like, well, what is ESG investing anyway? Here's the guy who's married to somebody who's doing it, So I think that you kind of have to just roll up your sleeves and figure out the best way. But there are a number of resources too. But the Institute also, I know, has had increased emphasis on ESG investing, or even just this podcast is an example of that.
Let me, obviously our audience is Institute members and financial advisors who listen to this podcast, but there's another audience that may be listening, and those might be folks who are 401k plan participants. And any thoughts about whether we'll see ESG funds included in, say, target date funds or as standalone investment options in a 401k, and given the demand by the consuming public?
Yeah, I can't comment, and Sidney probably can comment on that, but I know a number of 401k providers have written a number of papers on this. Calvert is one that I've seen what they've done. And I think that we will continue to see this. Now, how they're going to position it might be, a little bit different. But I think it's such a positive sign that the data came out with this return in this recent downturn. And obviously, it's a very short period of time. But if you look at things like, beta investing, we didn't have that a few years ago. And people had to figure out, well, what is it? Talk about education. That one really requires a lot of education. But so I do think that we're going to see more of it, because if we look at that, some of the stats that are in the article, investors want this kind of investing, and they want to have a choice in how they direct their investments relative to their value. But all things being equal, as Sidney said, so we need to look at those return expectations and what environment they're going to do well. But importantly, look at it within the context of your total portfolio. And so just as you would any style analysis or any kind of asset class and things like that. So.
And I guess, Sidney, did you want to add to that?
Sure. I think certainly in the DC space and with 401ks, you're going to see some movement in that area, and especially with the larger companies when they're coming out with the research to kind of, I think, lay the groundwork. And then even if this proposed rule becomes a final rule, and let's say it's not changed, then they're going to document go through those steps of making sure that they're not that the products or investment alternatives that would have the ESG component or be ESG based is going to fit the parameters of what this more restrictive rule is indicating. So making sure that they're not subordinating the financial or economic returns to the non-financial returns. Also, I think giving some background or some insight or transparency into how they came to that decision, documenting it appropriately. So as part of what I think Margaret touched on earlier in terms of a fiduciary process. So they're going to be able to go through those steps, and especially having the research in place is going to help them make that process much easier. So in terms of working with their consultant and then getting their, whatever their plan board is in place, getting them comfortable with that as well, that they've appropriately documented it, and to keep that process moving forward in that respect.
You know, I would just add one thing to that as well. As one who was head of an outsourced CIO group for retirement plans very early on, you know, before people would accept that. And this particular firm we're co-fiduciaries anyway. We might as well embrace it and act as a co-fiduciary. But speaking for myself and other professionals in the industry, I think they take that fiduciary responsibility very seriously in terms of how they would integrate this type of investing within the portfolio, whether you're a committee member, an advisor to plans, or somebody that's just overseeing the investment process. But that's the gold standard, really. Am I acting as a fiduciary? And Sidney, you can, correct me if I'm wrong, but I think that's a big, broad thing, the prudent man rule and those kinds of things. And those, even if you look at foundations and endowments at that fiduciary role under MIFA, that's evolved, and it has in the retirement space. So I think we'll be able to handle it and not explicitly carve out the ESG, but just integrate it as far as part of what we're doing.
Mm. So every answer begets another question. You'll forgive me, but maybe this will be my last one, which is when you talk about this not being a fad, I'm reminded I have children who are in their 20s. I don't refer to them as Gen Z. I refer to them as the Robin Hood generation, right? Because they invest using Robin Hood, and goodness knows whether they're making money or losing a lot. I don't know. But any thoughts about like the effect that I'll call them the Robin Hood generation will have on ESG investing, given that they're at the start of their investing careers?
Yeah, all of the data that I've seen points to this generation and women that are very interested in incorporating this. And if we look at that generation, I'm not talking about your kids specifically, but this particular generation is burdened with a lot of debt and a lot of other considerations, but also this has nothing to do with investing, but it's just the attributes of this generation, the research I've seen. They just look at things differently. They don't want to own things, so they'll do Uber instead of owning a car. They'll do Airbnb, instead of a hotel. So this generation is incorporating these values implicitly. And that's just how they are. Maybe they aren't into material things because they have so much debt, who knows? But I do think you're right that this generation looks at things quite differently than certainly the baby boomers.
Yeah. So anything that we haven't touched upon that you'd like to mention before we wrap up, or anything that you've touched upon that you want to reemphasize?
I just think this is a really exciting area. And as I said, I wasn't first on the bandwagon, but I think now for retirement, it's so important. Just if we look at retirement, so many people are not saving enough for retirement. They're not thinking about it. And this is a way, I truly believe as an investor, to capture inefficiencies. This is early on, and not everybody is looking at things this way. So for me, it actually not only is equal, but is a superior way to enhance your returns.
Sidney, you get the last word?
Well, I would agree with that, and it's as long as you adhere to a fiduciary process, it's not you're not in it for the greenwashing aspect. You adhere to fiduciary process, you build it, you integrate it with your overall investment process, and you document it, you're going to be fine.
Sidney, I want to thank you for being with us on the Exceptional Advisor podcast. We appreciate you sharing your knowledge and wisdom.
It was a pleasure.
It was a pleasure. Thank you for having me.
Thank you for listening to this episode of the Exceptional Advisor podcast series. This episode is brought to you by the Investments in Wealth Institute's Women in Wealth program. Don't miss the upcoming Women in Wealth Week, March 8th through the 14th, and mark your calendars for the first Women in Wealth webinar of 2021 on April 26. Learn more about Women in Wealth, upcoming events, and how you can get involved by visiting iwicentral.org/Women in Wealth. Stay up to date and have the latest episode delivered straight to you by subscribing through iTunes, Spotify, or wherever you get your podcasts. The Institute stands ready to help you with new resources, research, programs, accommodations for candidates and certificates. For more details on resources available, visit www.investmentsandwealth.org.